you're in the technology sector, generally already you will have a much higher multiple, say like, between 5 all the way up to 100 times multiple, right? And then within that, which one it is, I think have a look at what is your particular industry, what are some of the, deals that have gone through similarly, especially, the really successful ones. And so you want to sort of model yourself to where the next X for this particular industry, right?
Hey guys, it's Linh Podetti here. In this episode, you will meet Melissa Ran, who is the head of community at AirTree Ventures, one of the largest venture capital funds in Australia and New Zealand, backing the most ambitious founders of world-class tech companies like Canva, Linktree, Employment Hero, and more. She works alongside the world's best tech startup founders and investors who are actively shaping the future. In this episode, we deep dived into questions like how to get funding for your startup, what's the pros and cons of getting funds from venture capitalists, what these companies look for, and how to pitch your business and more. So good to have you here, Melissa. We finally got the chance to catch up.
Very happy to be here.
So Melissa, we met because we were in this Asian Australian kind of group, and I love that we're both passionate about not just entrepreneurship, but also helping our race, our culture to also leap through this competitive world out there. But the one thing that really interests me is where you work at and the things that you do, which I have no idea about, which is really about raising capital through venture capitalists. Because I've always started, I started my business with my own money, never needed to borrow, but I was always curious. It's like, what if I had more money? What would I do with it, right? And so I would love to hear from you a little bit about, your background. How did you get into the business you're in and what the company does?
So my name is Melissa Ran, and I'm the head of community at AirTree Ventures. AirTree Ventures is a venture capital fund that focuses on investing in the best technology entrepreneurs in Australia and in New Zealand. We started in 2014 with a fund of about 60 million. And now in 2021, end of 2021, 22, we have a portfolio of companies, around 77 portfolio companies, and they are valued at over $2 billion. And we might have some announcements. It might be going up even more in terms of valuation and the size of our fund. So we, invest quite actively, and we are one of the most well-known and established funds in Australia and the New Zealand region. In terms of the stage that we invest in and the check sizes, what we call, so the size of each of our investments, we really would love to be the first check that any founder or entrepreneur takes. So often we've invested where there was no product even, so pre-product and pre-revenue as well. About, I think 34% of our investments are in pre-revenue startups. So they might have a product, but there's no revenue. And then because our fund size is quite large, we can go from the first check all the way to follow through as the business grows, all the way until they, maybe list on the stock exchange or they sell to another business. So in terms of the size, typically our smallest check size at the sort of pre-revenue, pre-seed stage round is $200,000, and it could range all the way to 25 million.
Wow.
So
that's amazing.
It's of course a huge range. I would say that nowadays, what is typical and what's normal, probably the first check size from 500K to a few million. So maybe like 1-2 million is probably the average nowadays. And that's just a sign of both in Australia and internationally, the startup industry has really grew a lot and it's really exploded. And so because of that, I think in the last 10 years, people are now saying, wow, for example, Canva, right? Like our very...
And that's one of your investment as well, right?
Yes,
I saw
that's
that on
right.
the website.
Yes, exactly. Yep. Yes. We're very privileged investing in Canva and Linktree. Who gives a crap? The sustainable toilet paper company. Yes. They really, went very well during COVID as well. So a lot of examples of during COVID, businesses have accelerated because of this industry as a whole, not just in Australia, but globally has really grown. So a lot more interest in the traditional investment community is now looking at startups and the start tech sector, right? So everybody now wants to get in. So whereas before it was very difficult for technology entrepreneurs to get money and very difficult for venture capitalists like us to raise enough money to invest into startups, nowadays it's a lot easier and there's a lot more interest. So because of that, the valuations of companies start going up. At the same time, I think the talent and the entrepreneurs starting businesses, it could be that now they're starting their second, third, fourth businesses with all of the networks and experiences of the last few experiences that they've had, right? And so all of these reasons has sort of made the industry a lot bigger. The investment side is a lot bigger. Even the cost of talent, you would know a thing or two about the shortage of technical talent in Australia and in the US because of COVID, because there's less international movement. So now it's more expensive to hire people, right? Which means to get the same amount done, you're going to have to raise a bit more money to just hire anyone. So there's just been, inflation at every level.
Money, yes. So tell me, you mentioned technology companies. So I know Linktree, Canva are all like tech companies that you guys invest in. But the toilet paper one is not a tech company. And so tell me, what kind of businesses do you have a chance being invested by a company like yours?
Yes, the toilet paper one, because they are still e-commerce, right? They are still very strongly tech-enabled. In terms of the main focus for not just us, but generally venture capital funds, it's about businesses that have a high technological or a high scalability component to it. When we say that, we mean typically, so if you take a software company, right? Once you make the software, selling an additional unit, right, doesn't require the same amount of effort as you putting in the original version. Whereas say if you're a restaurant and you're selling a bowl of noodles, you can try to streamline things, but every bowl of noodles, you're going to make it on the spot, right? You're going through the same thing. Whereas you do not make software from scratch when you sell the additional unit. Where there's a technology component where in the very beginning stages, there might be a big capital requirement to build the thing. But once it's built, it can be sold and it can be given to users to use and to impact the world in a very, very fast way. Typically,
so products is fine because it's once the product's made, designed or created, a brand's there, it's scalable. You believe that it's scalable and you would invest in that. Are you looking at some sort of amounts of that it's scalable up to for you to be even interested in it?
I would say we don't give hard and fast rules. I mean, just as, if you look at our portfolio companies, you will probably see, okay, maybe 80 to 90% are software, mostly software, but then you still have 20% where there's a physical product involved, the physical services. But with those, typically it is enabled by technology to make something that's traditionally not as scalable, more scalable. We don't have a specific number of how scalable. It's sort of based on your specific situation and comparisons with others in the industry. For example, we have in our portfolio both hardware and software component companies like Neura headphones. So they manufacture headphones, but they also make software, AI software that makes the sound basically personalized to your ears, right? But then we also have purely software. So say something like Canva, right? It's just 100% software businesses. So it varies. And then we have medical devices, or we have all the different industries, medicine, agriculture, education. It's more about the way you think about it is that one of the judging criteria of the investment is how scalable is it? But that is just one consideration amongst many other considerations. Such as the founding team, such as the size of the market. I would say one of the most important is the problem that you are solving. How painful is that problem to the market that you are addressing, right? You might have a fantastic that you think is a fantastic idea, that you think the world needs this, but the customers don't even understand they have this pain point and they're very much not motivated to take action or to pay you, then that's not going to make your business really grow, not really going to get, the revenue through the door.
Okay. As an entrepreneur, you think you have a great product and here's an option. You can go to the bank, you can go and ask friends for money, or you can get venture capitalists. What are the pros and cons of venture capitalists?
So I'll go through the pros first, right? So the pros is that as venture capital funding, if your business is one that is in the category of highly scalable, fast growth technology company, right? If it's in that category, then to get venture capital funding, it means that you do not have to get into debt, right? Off the bat, right? And so it is investment based on equity. So what you give is a percentage shareholding stake of your company, right? Instead of having a big, $1 million loan over your head, right? Because if the company goes to zero, it goes bankrupt, right? Your shareholders, they just all lose their investment. Whereas if you mortgage your house to get a debt and the business doesn't go well, then you still have to pay the $1 million back. Right? That's sort of equity funding benefit, but that's only one small element of it. The biggest pros that you would get is if you get investment firms such as AirTree, that are quite well known and that have invested in a community of other very successful startups. What you're going to get is that network and that community, right? So essentially, you now belong to this it's almost like getting into a really good school, right? So you get the support of the rest of the alumni. And so now you belong to this wonderful community of other most successful businesses. And of course, we are here to make you succeed. We want everyone to succeed. So we will introduce you to other talented people, give you a lot of opportunities where if you were doing it by yourself, you're encountering a problem for the first time and you're not sure what to do. Whereas once you're a part of the portfolio community, literally there's like 10, 20 other startups who has just done what you're about to do. Just ask them what they did. So it's like, it'll give you a lot of that sort of actual know-how benefits of how do you actually go from nothing to something, from 1 employee to 10 to 100 to 1,000.
Yeah. So apart from the community of those other businesses, do you also act as advisors to the business, not just giving the funding, but AirTree, the company itself, has kind of vested interest in, the right knowledge and stuff too?
Exactly. Yeah. Yes. You would find that nowadays, any good venture capital fund will try to offer not just money, but everything else they can to get your business to be successful. Because obviously, where, as I mentioned, we basically become minority shareholders of the business. So the more successful you are, the more successful we are. When you're choosing a fund, you're really choosing which group or which fund do you think has the capabilities to help your business the most, right? Yeah. That actually brings me to sort of the last pro, which is there's also a brand and an awareness and a credibility element to getting venture funding. So,
I see that whenever someone gets funded, it just sounds so good. Like, this company just got, $3 million funding. It's just really, really good for the brand.
Two things to mention here. The one thing is that we definitely want founders to focus on the fact that getting the funding is just the beginning, right? You get the funding, then you actually build a business. So this is not like the end goal isn't just to get the glamour of getting venture funding. But why it's good is that it is a signal. It's a very positive signal to the market that says, out of all of these businesses, you've been singled out by these professionals who literally look at and judge businesses all the time as the one that has significant potential, right? And now they've given you all of this money. So that signals, okay, you actually have money to go hire people. And so when you're hiring the best talent, sometimes if you want someone to leave a great job to come join you on your journey, they might be worried that, is this going to go bankrupt in 6 months, right? If they know, these big name VC capital funds has invested money, then at least they'll feel like, okay, I know that you'll at least have enough money in the bank account for like the next year and a half, 2 years, and that they would then have networks to future investors, right? So it's just making you feel that this project is higher potential and is, a bigger chance of success, right? So with that, it's easier for you to hire, it's easier for you to find customers and to find future investors. So I would definitely say that's a very big, important part of it. It's almost like having a stamp of approval and, becoming recognized as one part of all of these other amazing companies. That does mean a lot.
That brings me to, what is the con? Like now that you've got all that benefit, what are the cons of it?
Yes, exactly. So the first thing to mention is that, are you building a business that actually would have the kind of growth trajectory that venture capital funds needs? Okay. When I say that, I sort of have to explain a bit about how venture capital funds gets the money. $500 million that we have to invest. Where did that come from? That came from other investors that's made up of either big institutions like superannuation funds, private wealth funds that other people have invested in, or high net worth individuals. So for them, why would they invest in a venture capital fund? Because they don't have the expertise or the time to go and invest in this particular high risk category, right? But it's like high risk and high reward. So because this category, we are investing in startups from the very beginning, it's going to be, maybe 7 to 10 years before there will be an exit situation, right? Otherwise, you wouldn't, know how it'll turn out until then. So their money is locked in for a long time. And, when you're dealing with these kind of highly innovative industries, it's very high risk. It might not work out, right? So most businesses don't work out, as you know. So because of that, they have a requirement of, a level of growth and a level of return that they would need to get. And so what that means for the venture capital fund is, unless this is a business that could really, 100 times that level of growth and acceleration, then it's just a business that doesn't necessarily make sense for the venture capital model. Okay. So if you are not one of those businesses, for example, you're building, a lifestyle business, you build a little digital product online, it's doing very well, and you just want to grow it at your own pace, because the whole point of you doing this business is so that you have more flexibility, spend time with your family. Maybe, you get to a point where it's automated and then you're only working 4 days a week. That's like your ideal life, right? Then it might not make any sense for you to sign up in this sort of fast lane where you're saying, invest in me now, I'm valued at 1 million, but I'm going to be valued at 100 million in the next 5 years. And to do that, I have to hire 100 people, so it's like you've then turned it into this venture capital backed juggernaut where you're trying to be the next $1 billion company or the next whatever. But once you get onto that path, you are committing to that level of growth, right? Otherwise, why would people...
That's such an aha moment here. It's really about, what do you want in life? What's your lifestyle? Like if you want to work,
and what is your purpose of that business? Yes. And the other thing is that, it might be that you are passionate about food, and so you are opening a noodle shop. Like that's wonderful. We need more wonderful food and restaurateur F&B entrepreneurs, right? And so it might be that that's the business you want to do, and you can certainly use the power of technology to make that business more scalable. But in terms of getting capital, there are other ways to get equity capital that's not venture capitalists. For example, angel investors. For example, if you're in a social impact space, there are impact investors. There are high net worth individuals who, for example, they're also passionate about noodles and they just want to support F&B business, right? And so for them, they know that in this industry, there's a different level of possible growth, and it's a different path that they might want to take. And so it's all about finding investors that has the same values and the same expectations. It's just like a marriage, right?
Yeah. So what is expected of you when you're working with a venture capitalist? What is those high commitment that you need to do?
It's definitely about needing to grow your business in a way that is very accelerated. Okay, so it's very much like right now, immediately say you're doing around, it's $10 million. Okay, $10 million is now in your bank account. What are you going to do with it? Most likely, right, the vast majority of the cost is you're going to hire talent, right? And then you're also going to allocate some capital for them to do. So for example, if you want to hire a CMO, the CMO is going to need a budget, right? You're going to hire a CTO. Okay, you want the CTO to build a certain system. The CTO will say to you, well, I need 10 people to build this, right? So then now you are forcefully going out there to hire a big team. So now if you imagine, okay, now you're going from managing 2 people to now managing 100 people. What does that mean for you as the leader and the growth you're going to have to undergo, right? All the
and how much reporting do you have to do back to the venture capitalists? Do they expect to meet every month, get reports or something, or no?
No, definitely we don't want, especially at this early stage, we don't want to add unnecessary, reporting regulatory burden on the founder. We definitely understand how early stage businesses work, but generally, as we practice, boards meet every quarter at least, right? And generally there's some kind of reports about how the business is performing. Yes, it's certainly not as involved than if you were a public company, but if you wanted to set it up right, I mean, many businesses, they don't even have a board, right? But generally when it gets to, if you're working with people like AirTree, we're very experienced in businesses that does have that structure. But a lot of that is, we're here to make building a business easier and more likely to succeed for the founder. So it is dependent on what the founder wants. Often, we really look to the founder to go, we trust your vision, we trust your experience in this sector. So you do your magic, and where you need help and you think we can help, we're here if you need us. We're hands off, completely hands off if you don't. Okay. We really try very hard. Not every investor is like this, by the way, but we definitely try very hard to not crowd the founders or the entrepreneur style. Right.
So when do AirTree, for example, expect to be paid back? So let's just say the founder's got this bunch of money. Is it like at the end when it gets sold, or is it some sort of dividend along the way?
So that depends purely on how the business is growing. So typically in the venture capital life cycle, when investors invest us money, we kind of say to them, expect this is a 10-year life cycle. Okay. So don't expect to get all your money back until after 10 years. But in between that, it depends entirely on what's happening with each of the businesses. So for example, if you build this business and 5 years later, you decide to sell it, right? And so in that moment, we get all of our money back plus whatever increase in value, right? So then for that particular business, we've exited the whole thing. But we, at the same time, right now we have 77 businesses, right? So all of those will be at different stages. Some of them, it might be that it'll take 10 years to list. And we have had the experience where we have had a business list, but we didn't sell our shares. So we're still holding it because we think, there's still
going to go up more
potential, right?
Yes.
And so we can make a decision about at that stage, how much do we sell? And if we sell, and then also it's at every stage. So say, you do one round with us, and then in another 2 years, you go and you need to raise more money now. And so you raise more with some money from us and then more from other investors. Now, at that time, depending on how the business is going and what the interest is from other parties, we could actually sell some of our shareholdings to any of those new people coming in. Okay. So I guess the short answer to your question is there is not a set expectation of what the founder has to do. It's more about, let's build this business together and look at all the opportunities that are coming up, and together with the founder and the board and the other investors, because, for most businesses, you don't end up just having one investor. Or once you've gone down the venture capital route, you would have quite a few different people.
So you might have AirTree, but you might have other investors. Yes,
absolutely.
Way.
So like, for example, you might get your angel investor in the very beginning, and then the institutions, and then they get bigger, and then you might have private equity. So like they're even later stage than venture capital funds. So then you end up having a cap table of a smorgasbord of people. Yes. And so then it's about to the next stage, managing the new incomers and the existing people. And so there's definitely opportunities for people to negotiate, exiting a certain amount of equity, and the founder as well, right? So the founder might, what we call, take some risk off the table. So it might be that if the business is going very well, and the founder can say, in this new round, I'm going to sell a little bit of percentage just to get some cash so I can put a deposit in my house, I
was going to ask that question. When do you actually get to reward yourself along the way?
So the better your business does and the more interest your business has, you as the owner has more leverage. It doesn't have to be, waiting for the very final exit or waiting for the IPO. But obviously, that's dependent on the business going well. If it's not going that well, and say you're running out of money and then you're having trouble even getting new investors, then maybe the existing investors will work really hard to get new investors in. But in that scenario, the business's relative negotiation position, it probably isn't as good, right? And so it might not look so good if you decide to sell some shares to new investors, and then they're like, whoa, then do we want to touch this? Yes. So it's all dependent on the situation.
Well, the big question is, how do we propose our business to someone like AirTree? What happens and how do you assess?
Yeah, absolutely. The typical way is generally businesses would put together a presentation that outlines all the highlights of the business. And that's what we call the pitch deck. And there's lots of resources on how to put together a good one. I'll send some through after this call so you can include it. And then generally, you would then contact the different venture capital funds that you think are suitable. So this is where understanding the people you're approaching is very important. So there's sort of 2 points. One is approach it like if you're getting into a marriage with someone, you got to date before you get married, right? So approach people as early as possible. Don't approach them when you're already about to run out of money or you're like desperately needing the money right now. Very hard for people to go, okay, fine, we'll invest.
They need to trust you, is that right?
Yeah.
It's like a relationship where you kind of, that people would probably invest because they trust your character, your personality. They kind of think that.
So
I believe in that person.
Exactly. It's either you've had a longer time to actually have that interaction, or you've done previous things where it's highly visible. And so even if I've not known you personally, it's like I might have followed your LinkedIn for a long time. So even if I might not know you personally, but I have seen the value you have been adding to a certain market, to a certain community over time. It's like building that trust, right? So the point is, go really early and try to showcase why you are the fantastic expert to be taking on the area that you're taking on. The other thing is, it does help if you can get a warm introduction to the people that you're trying to reach, right? And that's another thing about trust and credibility. So if you have someone that's saying, Lin, Lin, best entrepreneur I've ever met, right? Of course, you're going to get your foot in the door a lot easier, right? However, we very much understand that it's very difficult as an industry where if we only talk to people with warm introductions, then really it's about people already privileged, already in a certain circle are going to get more opportunities than other people. I do think certainly in the Australian and New Zealand community, the venture capital industry has done a lot to try to make it more accessible. So at least at AirTree, we have initiatives that we call the open source VC. So we have published a lot of the sort of information about how VC work, what we even putting out term sheets. And then at the same time, we also have a contact form on our website where anyone can submit a pitch deck. So it is looked at by the team.
Okay. So you said to submit. So you basically contact and send a pitch deck.
and it should be short, precise, and then they'll get the point. And then if you're good, they'll invite you for a physical meeting. Is that how it works?
Yes. Well, I mean, over COVID,
Zoom now.
call or Zoom. Yeah. So definitely, invite for a meeting. And then maybe there might be several meetings. And the final meeting is what we call the partner presentation, where the entrepreneur would present the business to the partners of the firm who make the investment decisions. And if the partners at AirTree, it's a voting system. So a certain number have to vote. And if it's like, we get enough strong yeses, then we're going to go ahead, and then you'll get a term sheet, which is essentially, it's like a very short form contract that sets out the terms. So how much money we propose to put in, at what valuation, for what equity stake, what other conditions there are. And then there might be a bit of back and forth between the founder and us and other potential investors as well, right? And then, so for example, if another investor comes in and says, we can do at higher valuation, we take less equity, and then you kind of have to decide, okay, but this other investor might bring more, or maybe we can negotiate them down. And so this is sort of a conversation.
So do you recommend pitching to multiple people at the same time, or is it wait for one at a time?
Definitely multiple. It's a bit like applying for jobs, because you want to get a bit of that artificial hype and demand going as well, right? So if you can go to one investor and say, please make a decision by X date, because we're also talking to quite a few other investors, or we've already got a term sheet from XYZ, let me know ASAP. You could speed things up a bit and get that hype, right? Yes, definitely. So it's that, all of the things that you think about in terms of negotiation and, putting yourself in a good position with leverage, that typically is what will get better results. As I mentioned as well. So A is that in terms of submitting the pitch, it is better that if you have an introduction, but if not, you can go direct. At very minimum, for AirTree, we have on our website, you can submit. So anybody can submit. There's no barrier. But you are a very smart entrepreneur. Even if you have no warm intros, right? Like if you cannot think of anyone who could possibly introduce you, right? Then online, there's ways to directly get in touch with the people in the team.
Like Melissa right here.
Exactly. Like I am on LinkedIn, all of our team, go to our website, look at who has what role, right? Even on our website, we put who has invested in what businesses. So you already know what industries are they familiar with, what industries are they looking at, right? Target that individual, find them on Twitter, on LinkedIn, and really a lot of our blog posts, we even put our email address down the bottom. So at AirTree, it's everyone's first name at airtree.vc. Okay. So there's no excuse that you're not personalizing your approach, right? But really, the best entrepreneurs, like I would be very surprised if somehow you can't get any warm intro to anybody at AirTree or anyone else, because you can just go one closer, right? You can go someone who's 3 steps away, then 2 steps, and then 1 step. Right.
Great
nowadays.
Tip. I love that. What are the chances of you guys investing in like marketing agencies or service-based businesses like that? It's tech, it's online, because a lot of my viewers are all starting some sort of outsourcing or business that you can, you work online and you provide services all around the world.
Well, you would then have to productize or somehow have one element of your business that is more scalable than a traditional agency. And a fantastic example of that is Linktree. So Linktree started off as a influencer agency for the music industry, and they built a very successful business, but obviously it's a service-based business. It's not scalable. And for some of the work that they were doing, they themselves created what later became the Linktree link. Yes, because they had to constantly manage, right, highlighting different links for all of their music acts. And they thought, there's not enough space on Instagram. What do we do? And so then they go, okay, let's just create one link. And then on that one link, we can put everything. So they started doing it just as a tool to solve their own problem as an agency. And then they noticed that as they were doing that, other people were adopting what they have, and people was like, how do I also get a link? That's what I want. And so then they realized they started
turned into a software
traction.
kind of company.
Yeah, exactly.
So you're suggesting that unless you kind of come up with a product like a software, it's unlikely that you could get venture capitalists, because it's very service-based and people.
Yes, it's the scalability angle. Yes. But it doesn't mean that you can't get equity investment once again, because I mentioned there were other types, right? So if you want investment, you still can, but the traditional venture capital model, we just have a much higher bar for the kind of explosive growth this business needs to have. Yes. And the other thing is I have to be transparent. So with venture capital funds, they typically target between at least 5 to 20% of a business. Okay, so and in fact, it's most likely 15 to 20%.
Yeah.
And the reason for that is, once again, to do with that uplift in value. So if you imagine, if we invest in 100 companies, maybe 90 of them go belly up and they become nothing, right? Like for us, we're doing much better than that, but you have to think just the average businesses, 90% of businesses fail, right? So then you're depending on the 10% to give you an outsized return that would cover the rest and then some. And so that means that every business, you have to have enough of a significant equity holding of it, and they have to have the potential to really grow. But you really have to think of it as, is this $1 billion business? Can this be a global, huge Canva-like success? And those are the businesses that's more likely to get venture capital. Yes. However, once again, there are other equity funding options, and even, things like venture debt, and even things like you're getting funding based on your revenue. So if you are a software company, but you're growing a bit slower, then you can sort of use your future revenue to back certain investments. So certainly there are lots of different options, but I'm just saying the traditional venture capital fund model, as it is today, it does have that scale requirement.
Yeah. Well, I can sit here all day talking to you about this stuff because it's so interesting, but I'll just ask one more question is that, let's just say as a founder, you obviously just want to make more money, grow more, right? Do you have to know how you're going to grow it and how much you need and what you're going to do with it before you kind of go to anybody, right? You can't simply go, okay, my business is really great, I really want to grow to 10 million and come and help me and give me money, right? It doesn't work that way, right?
Yeah. The more understanding or the more clarity you have on your future plan, the better. Of course, we don't expect, anyone to know everything already before you do it. And, often it's like whatever you plan, things will go out the window, but it's about the exercise of having thought things through. So having done enough research, for example, like if you've already built a business, then you should generally have an understanding of what are the drivers to get your customers through the door, right? What is your acquisition cost? And what are your existing channels and how effective have they been? And with this additional money, is it more money behind the existing channels? What new channels are you trying to do? And if you were to do that, how many more people will you hire? How much will it cost to hire those people? So that kind of general business planning, right, you would need to have done before you're going out there asking people to give you millions of dollars. Yes. But we don't expect, you to sort of really very, very accurately predict the future. But at least to showcase you've thought deeply about it and you really know your industry and know your customers.
Actually, last one. Do we have to know already what our value of the business is, or do you assess it and tell us that your business is worth this much based on what you've given me?
Definitely, it's good for the founder to already have an idea. So typically the founder would propose, think of it as a negotiation, right? Definitely the founder, you want to be strong and start. Of course, we're on the other side of the table. So everything I'm saying to you is like, I'm being real and helping the founder.
And honest, you're helping us here. Yes.
So as the founder, you definitely would, even as a part of your pitch deck, you would be saying, I'm raising X amount and X valuation, or say, I'm looking for investors to fill 20% of my business for this much money. So you set the valuation, and how you would set that is, you look at other similar businesses like you and the potential that they have, and then you sort of come up with a multiple. Just know that technology businesses, because of the tech element, they work to way more different multiples than traditional businesses. That's the other reason. So in terms of valuation, right, a traditional business, it might be that you're valued at just 1 year's revenue or 2 years, 1 to 2 times revenue. But some tech businesses, it ranges so much. Some could be 50 times, 100 times. Okay, you look at the ones that's on the stock exchange right now. Okay, just look at their revenue, look at their market capitalization. So that's why it really varies. And I know that's very frustrating, because a lot of founders are like, what accounts for it? Hype. But besides hype, the actual technology, right? So if you have a technology that, if you really go big, you become a monopoly. Okay, you're the next Google. Then it's like, it has a type of value that is just way beyond than just what that tool is.
Potential is so high.
Exactly. Yes, because it's not just, it's say like, if you look at Google and you just say, oh, it's just a search engine. But then when you look at it, they own the entire online real estate for anyone looking to do anything, right? So, and then all the things that you could put on top. So that's why a company like that has that crazy multiple versus a traditional noodle restaurant, for example,
Yes,
right?
yes.
Obviously, it's not just hype, but it's like if you're in the technology sector, generally already you will have a much higher multiple, say like, between 5 all the way up to 100 times multiple, right? And then within that, which one it is, I think have a look at what is your particular industry, what are some of the, deals that have gone through similarly, especially, the really successful ones. And so you want to sort of model yourself to where the next X for this particular industry, right? And this industry is the whole market is this big, and then it could be, even bigger. It's about telling that inspiring story and having a vision, right? Yes.
Thank you so much. We've gone over time because we could sit here all day. There's so many questions I want to ask. Well, thank you so much, Melissa. I'll get all your details and put it all in the bottom of the description so that people could check you out, connect with you as well. So thank you, Melissa, for your time today.
You too. Bye-bye.
Thank you so much for watching, guys. Hope you enjoyed this episode with Melissa. I definitely learned so much. What business you are running, and if you are now considering whether you're going down the path of venture capitalists, love to hear in the comments below. Now, if you want more content around business and outsourcing, then check out my next video.